Let's finish off Chapter 11 with a mention of retained earnings and stockholders' equity. As a brief review, the statement of retained earnings is a summary of the activity that occurred in retained earnings during the period. It begins with the balance at the beginning of the period. If a company has net income, it is added to the beginning retained earnings balance, and if a company has a net loss, then that would be subtracted. Any cash dividends declared are subtracted to arrive at the ending retained earnings balance. Now, prior period adjustments are corrections of material errors, those are big errors, in prior period financial statements. These errors include arithmetic mistakes, unacceptable accounting, and missed facts. Prior period adjustments are reported in the statement of retained earnings or the statement of stockholders' equity, net of any income tax effects. Prior period adjustments result in changing the beginning balance of retained earnings for events occurring prior to the earliest period reported in the current set of financial statements. To illustrate, assume that COM US makes an error in a 2013 journal entry for the purchase of land by incorrectly debiting an expense account. When this is discovered in 2015, the statement of retained earnings includes a prior period adjustment as shown on this slide. This exhibit also shows the usual format of the statement of retained earnings. Most public companies issue a statement of stockholders' equity rather than a simple statement of retained earnings. The statement of stockholders' equity is more inclusive and discloses changes in all the equity accounts, not just retained earnings. The usual format is to provide a column for each component of equity and use the rows to describe events occurring in each period. This slide shows a condensed statement for Apple. Notice the column labeled Retained Earnings has the information from the Retained Earnings statement. There is some information included here that we have not studied. You will continue to study that if you continue with intermediate accounting courses. The income statement reports earnings per share, also called EPS or net income per share, which is the amount of income earned per share of the company's outstanding common stock. The basic earnings per share formula is shown here. It is calculated as net income minus preferred dividends divided by weighted average common shares outstanding. When a company has no preferred stock, then preferred dividends are zero. The weighted average common shares outstanding is measured over the income reporting period, and its computation is explained in advanced courses. A stock's market value is determined by its expected future cash flows. A comparison of a company's EPS and its market value per share reveals information about market expectations. This comparison is traditionally made using a PE or price earnings ratio, expressed also as price earnings, price to earnings, or PE. This is one of the most popular ratios cited. Some analysts interpret this ratio as what price the market is willing to pay for a company's current earnings stream. Price-earning ratios can differ across companies that have similar earnings because of either higher or lower expectations of future earnings. The price-earnings ratio is calculated by dividing the market price per share by the earnings per share. I hope this chapter was interesting and practical for you as you think about your business career. It is important as a business person and a potential investor to understand how a company interacts with its own owners and its lenders. This concludes our discussion about the balance sheet and related income statement accounts. We will look at my favorite financial statement, the statement of cash flows, in the next video series. Thanks for being here.